There were many who were wondering whether or not Uber's IPO would be a success or a failure, but a good amount of people prepared for success, a good amount prepared for failure. What may surprise you is that some of the people who were bracing for failure were the very people who were actually selling the stock and what steps they took to make sure it overperformed even when it was underperforming. Before we talk about all of that, let's have a word from our sponsors. And today's video is sponsored by Maximo, the rideshare automation app that allows drivers to safely and easily accept ride requests for Uber, Lyft, and Postmates. Whether you drive for a single platform or multiple platforms, Maximo's custom settings can help you drive more efficient, less distracted, and help you maximize your earnings. It will automatically accept one trip, turn off the other apps, and when your trip is over, it will end it, open the other apps, and accept the next trip, all without you having to touch your phone. Use referral code APP60 and get your first month free when you subscribe to Maximo. Hey everyone, this is Kevin the Apptrepreneur, and yeah, we're still talking about the Uber stock. Something tells me it's going to be a topic for a long time because it did not perform the way people wanted to perform. It's doing a little better now, don't get me wrong. Some people have definitely recouped some of their losses, but there's just a lot to unpack here. I mean, from how they picked the person who's going to sell it, what the banks did to make money, what they did to make sure the stock didn't go too far down, and heck, even the partying, which we got to talk about in like a day or two, because there was like a pre-IPO party at Uber that honestly suggests the culture hasn't changed much. But today we're going to be talking about the banks and what they were expecting of the stock and what they did to basically kind of prep up the stock a little bit higher than what it should have been. Now, I of course am not a financial or legal expert. I'm just commenting on an article, an opinion piece, to be exact. So this is Josh's opinion, and this video is my opinion of Josh's opinion of Uber's stock. So a little bit like I like saying this joke. It's a little bit like the Matrix there, you know. I don't know. Or maybe that's breaking the fourth wall and it's a double fourth wall. Yeah, let's make a Deadpool joke. Anyway, this is from the Intelligencer. And it says, Matt Levine, among others, has been writing about the extraordinary measures that the investment banks running Uber's initial public offering took in vain to stop the stock from tumbling in its first few days on the stock market. First, there was a not extraordinary measure. The green shoe, typical in IPOs, where for every 100 shares the going public company sells to the underwriting banks running the IPO, the banks turn around and sell 115 shares to investors. Because the banks sell more shares than they buy, they end up with a short position in the company they've just taken public, which is a little weird. But company insiders give the banks an option to buy the additional 15 shares later at a fixed price slightly below the IPO price, which protects the underwriting banks from losing money on their short position, which helps avoid a perverse incentive for the banks to be afraid that their client's stock will go up. By the way, what does it mean to short a stock? Well, basically it means you're betting against the company succeeding. It's a little bit more complicated than that, but that's the long and short. Sorry. In this instance, Uber went public at $45 per share. The underwriting banks sold 207 million shares to the public, but they had only bought 180 million shares from Uber. So Morgan Stanley was going to have to go out sooner or later and buy up 27 million additional shares to cover the short position. They had an option to buy those shares from Travis Kalanick and various other insiders for 41 each. But you will notice Uber stock closed Thursday at 42.67, and on Monday it traded as low as 36.08. And by the way, as of the time of this recording, it's back up to 41 something. Who knows what it's going to be by the time this video is actually live, though. So let's see here. Why would the underwriters buy for 44.41 when they could buy for 42.67 or even 36.08? Of course, they haven't been buying from Travis. They've been out buying on the open market, making a nice tidy profit, more than they would have made if the IPO had gone like Uber wanted, with the stock price rising after the offering. Since remember, the shares the banks are buying are ones they already sold for $45. That's a short in practice. But rather than being a nasty way to make money at Uber's expense, This is framed as just another part of the IPO service. By going out and buying so many shares, the banks are working diligently to prop up the stock price, which would otherwise be even lower. Sorry. So if they weren't doing this, the stock could potentially have been lower than $36. Would it have dipped below 30? I don't know. I don't know how many shares they were buying per se, but it could have been lower. Now, the extraordinary part. CNBC reports the banks were worried Uber stock would do exactly what it did after the offering puke, and they weren't sure the flexibility to buy 27 million shares would be enough to keep the price up. So actually, they sold even more than 207 million shares of Uber in the initial offering, exceeding the sum of the 180 million shares they had bought from the company and the 27 million shares they had the option to buy at a fixed price. The excess over 207 million that the bank sold created what's called a naked short position. Not only did the bank stand to make money on this position if Uber stock fell, they were going to lose money if the stock went up. Now, let's pause here for a moment. There was a stock video that I was preparing where basically Uber was blaming Morgan Stanley, the bank that was preparing their stock for the market. And they were looking at them because it's like they felt that the bank had failed them. And I was going to make a video but decided against it because, in my opinion at the time, that story was, you had a bad day in the stock market. People found out you weren't worth what you thought you were. How is that Morgan Stanley's fault? But then you read stories like this, and by the way, even though this is an opinion piece, he is basing it off other stories. Like you can see the links are in the article. So other people have written about this. But here's the thing. Maybe Uber has a point that Morgan Stanley set out to screw them, because it sure sounds like the banks stood to gain a lot more if the stock failed. So now, of course, Morgan Stanley wasn't the main reason the stocks fell. I mean, here's the thing. If it was truly the unicorn people thought it was, it would have gone up at some point. It probably would not have gotten as low as it did. But the fact that they were actually buying more shares to prep up the stock, otherwise it might have actually been lower, that shows a huge conflict of interest for me. But I know this stuff is also fairly common in the stock market, and I saw Inside Job, I saw The Big Short, so I know enough to know that this is fairly common. But let's continue. A lot of people have been observing that this doesn't say great things about what the banks thought about their own IPO. Not only did they think they were going to need a lot of ammunition to prop the price up, they apparently weren't concerned the stock would trade above the IPO price, which is actually what you want and expect to happen after an IPO. They highlighted want and expect for that very reason. But even aside from the optics, it seems to me isn't creating a naked short position so you can buy more stock later, kind of like turning down your thermostat so you can turn it back up again. That's not going to make your house warmer. Why would selling a bunch of shares so you can buy them back cause a stock's price to be higher? Indeed, ordinarily selling a stock short is not just an expression of an expectation that a stock's price will fall, but an action that, done in large volume, can cause a stock's price to fall. I realize selling short in an IPO is a very different proposition than selling on the open market. The banks had already named a set price at which to sell the stock, and they knew how much demand there was to sell at that price, and so they presumably knew that they didn't have to cut the IPO price in order to create the short position. But that just governs the price at IPO. Once the stock is trading, having sold additional shares to create the short position means there are more shareholders out there with shares they are able to sell. Remember, most of the shares of the company are owned by insiders who already had pieces of Uber, but they're not allowed to sell until 180 days after the IPO. That's normally one of the factors that's supposed to restrict downward post-IPO pressure on the stock market. And by the way, all those people are probably pretty pissed right now because of how low the stock has gone. If you sell additional shares, you also make the IPO less oversubscribed, meaning you reduce the extent to which there were investors who didn't get as many shares as they wanted in the IPO and who might be inclined to buy more now that the stock is publicly traded. You, the bank, have more room to buy shares, but you've actually reduced the extent to which there are other market participants eager to buy. So I am skeptical that having a big short position available to cover is an effective way to keep a stock from falling, but what do I know? Uber stock, while still below the $45 offering price, has rebounded strongly over the last 3 days, rising out of disaster territory into disappointment territory, which I agree with. But in the long run, if Uber wants to keep its share price up, it will need something much more elusive than a good underwriting strategy. Profits. And there you have it. Now, again, this is an opinion piece, but it does appear that there was some insider deals being made. The banks definitely took out their little insurance policy. And this guy is skeptical if that was like a good strategy to have. But, you know, it is what it is, I suppose. Now, the Uber stock has been recovering. It could still go down. It could still be a disaster. Right now, it's in disappointing territory. We just don't know, because here's the thing. We've been watching Lyft for a few weeks now, and you saw the Lyft go up, then it goes down, then it goes up, and then it goes down. And the thing is, it does seem to go up, but then it starts to go down again, and when it goes down more than what you'd want it to. It hasn't really balanced itself out. So that's why I remain skeptical on Uber's stock. Once they hit $30, that's kind of, I will buy a share. Just so I can say I'm invested in the company. And then, as an investor of the company, I have the right to talk about them as much as I want on this channel, whether I drive or not. So, there you go. All you people who make those comments, you're just going to have to shut up about that. I have another reason for covering this story. Other than the fact that I find all this very, very fascinating and fun to talk about. I mean, we're supposed to have a little bit of fun on YouTube, right? But anyway, I would like to ask your opinion, especially if you are hardcore investors. I do a fair amount of investing, but I would no way call myself an expert. I got blessed and lucky a few times. I got Google when it was really cheap. I got Netflix when it was fairly cheap. I bought some Blockbuster stock, which was bought out by DirecTV, and then I got a bunch of DirecTV stock, and that helped fuel my investment career. I also bought a lot of stock in MoviePass, and, well, that didn't work out as well as I would have hoped. But I would like to know what all of you think of this. Do you think that the banks conspired against Uber? Do you think they had, like, a real, legitimate, how should I put this? Do you think they had a lot to gain from Uber going down? Sometimes that happens. I would love to know. So, comment below. Like, favorite, share, subscribe. If you enjoy my videos, consider becoming a Patreon member. It's totally optional, of course, but even as little as $1 a month goes a long way to helping the channel run smoothly and get access to my Patreon's exclusive blog. And with the gas prices getting you a little blue, check out the GetUpside app below. It's totally free, and you get cash back on every gas purchase. Subscribe to us at the Apptrepreneur vlogs. We try to put new content up every day to the best of our abilities. And if you want to talk to me or other people in the rideshare community, well, check out the Apptrepreneur Hangout at Facebook. And as always, flame responsibly. Have a good one.